Okay, it's just after 8:30, so we'll kick off with today's seminar. Thanks for joining us. Today we'll be talking around what we've seen in the M&A market over the last 12 months and the outlook for next year. For those that don't know Hurst, we are a regional accountancy practice based in Stockport in Manchester. I work in the corporate finance M&A team out of the Manchester office, associate partner. Nigel on the call also, he heads up the team. We're a team of 8. We are advising business owners and entrepreneurs with M&A transactions, both buy side and sell side. So we work with businesses looking to acquire. We help them value targets, structure the acquisitions, and progress them through to a successful completion. We also help with sell side and buyouts. So we help raise equity and debt to do shareholder buyouts with the ultimate goal of full trade and private equity disposals. On the call, we've got Tom Hall, who's a partner at Pannone Corporate, a law firm in Manchester. Tom specialises in company acquisitions and disposals. And Dan Martin, who is a senior director at Shawbrook Bank. Dan works in the corporate lending team. So his team are typically lending to businesses looking to do corporate transactions involving M&A. So the M&A market, I think it's fair to say that last year there's not many proper holidays taken by advisors across the country. Really, it was quite a manic year in terms of deal activity. At the start of the year, there was record volumes in Q1 leading up to the budget in March 21. A lot of that activity was kind of driven from the disruptions during COVID and businesses not able to implement plans that they had in place pre-COVID to do acquisitions, and then the access to capital and liquidity following the COVID disruptions and the increase in businesses wanting to do transactions at the back end of 2020, early 21. So deal numbers were at a record high at the start of the year. They tailed off in the back end, but are still strong going into 2022. As it says there's almost 7,000 deals in 2021 involving UK companies, which is an uplift on 2020, and now tracking pre-pandemic levels. In the Northwest, 2021 saw its second highest volumes in deal activity, with 883 deals worth a total of 22 billion. There's a lot of tech and healthcare businesses attracting strong multiples last year. And a lot of that activity is driven by overseas buyers and private equity investors driving up deal volumes. Nigel.
Thank you, Ben, and thank you very much everyone for attending and sparing some of your valuable time to listen to us. Just to say that we will have time hopefully at the end for Q&A, but if you do want to lodge a question with us, I think there's a right function on everyone's screen there. So as Ben said, 2021 was a fascinating year. In the early stages of COVID, the world changed dramatically. As Ben said, we didn't have many holidays last year, but we did have a lot of spare time in March and April 20 because all deal activity stopped. And if you'd said to me then what was my view in terms of what 2021 would be like, I'd have been hopelessly wrong, because it was much more active than I ever could have believed. So for those of you who are contemplating acquisitions, what does all this actually mean for you? Well, as Dan will talk about later, there's plenty of funding available, first of all, to support acquisitions. not only on debt, but also with private equity. So that what that does mean is that if you are really thorough about the or really keen and it's real part of your strategy, there is the ability to be ambitious and to raise plenty of capital to support you in the process. The downside of the current market is that if you come across an opportunity that comes to your attention through an advisor, or you get the direct approach, the likelihood is that that proactive seller will have a pretty enhanced view of value. Everyone's busy, everyone is talking up the market, so anybody selling their business and talking to advisors is likely to be getting the view that says now's a good time to sell, and multiples are very strong, which indeed they are generally. So what that means is that if you're serious about acquisitions and there's a particular target that you are interested in and is strategically important to you, the likelihood is that you, or there's a strong likelihood that you may have to pay more than you really want to. And that has an impact in terms of making sure you've got adequate funding, but also that you think through the valuation and why you're doing the acquisition, and it also goes to the due diligence you need to think about. That being said, the valuation issue for you is to a degree sector dependent. So there are some sectors, so for example, IT, TMT, healthcare, where valuations are, in my view, crazy. But that doesn't necessarily correlate to all sectors of the economy. So if you are in those types of sectors, you definitely will be in intense competition to buy those businesses, and B, having to pay high multiples. But as I said, there are some sectors that are unloved, where there's less competition and there's more value to be had. One of the things that I would say is that what we've seen is that owner managers have faced unprecedented pressures, if you will, going back to the crash of 2008. So at the crash of 2008, there was the recovery from it. Then we had all the ups and downs of Brexit. Then we've had COVID. So for a lot of owner managers, the last 10, even 15 years has been challenging. And certainly what we found is that COVID has really made people think about what they want to do with their lives and their futures. So there are sellers out. There are many sellers out there, and what we're finding is that they start off with the belief that their business has a value of whatever 10 times multiple. As they begin to go through the process and they gradually learn that there aren't any buyers at those sorts of multiples. So often I say to my clients, you've got to be patient. Allow them to go on the journey, realize that their business isn't valued at 10 times, it's a lower valuation, and allow them to come to that conclusion. So sometimes just being patient about the process and elongating the conversation and building a relationship over a number of years will pay off. I think the other thing to watch out for and think about, and I think the pressure is now beginning to come on, and we will talk later about just the world in general and inflation and the like. But a lot of companies who took on debt during COVID, not just formally in the terms of C-bills, but also just deferring payments to the VAT man, HMRC, etc., means that all that debt now is beginning to have to be repaid. Interest is having to be paid on C-bills debt. So in certain sectors in particular, and also businesses that didn't go into COVID in great shape, there are businesses that are beginning to sort of strain under that debt, and that will also create opportunities for buyers. The other thing that I would say is that in our experience, a lot of owner-managed businesses in particular don't think particularly strategically about their future and what they want to do in terms of exiting. So if you are serious about acquisitions, then a cold approach can actually be effective. So if you think about the owner-manager, he never gets around to thinking about the future and doesn't want to pay fees to be proactive. So a cold approach can generate a conversation. So we would always recommend that in looking seriously at acquisitions, you build a target list and make those cold approaches. And often that can lead to a dialogue. Might not happen, not happen straight away, but it's a good route in. And the other thing that we're going to talk about today is there's a lot of challenges out there which everyone on the call, I'm sure, are facing in terms of inflation and the like. And so due diligence, which we've covered in previous seminars and talked about the different streams of due diligence, is often backward looking. It's just checking what's happened in the past. There are no latent liabilities and no areas of risk. But really what we're now saying is that yes, that's still vitally important, but you've now also got to future-proof the diligence. Make sure you're looking forward at certain challenges, which we'll talk about as the seminar goes on. So, just going back to basics, why would you consider M&A? So the first thing is that a lot of companies that we talk to have got tons of cash on their balance sheet. People tapped into C-bills, then overheads were cut, and people stopped making discretionary spending to make sure they built a war chest. So for those companies that have got strong cash balances, you don't get any return on that at all, and the rising levels of inflation are further eroding the value of that cash. So we do talk to businesses who've got cash on the balance sheet, and it's a matter of frustration that they can't get a return from it, and so M&A may well be a useful deployment of that cash. But the more sort of strategic reasons for acquisition are, and this is what we talk to clients about, is about finding ways to generate more revenue, different streams of revenue, and also generate some cost synergies by buying another company and looking carefully at the cost bases of the two businesses. Particularly during COVID, when everything was thrown in the air and people started to think carefully about their business and also learned new ways of going to market. Businesses have had to think about doing things differently. So accessing new markets and new skills can often be the strategic rationale for M&A. Also, for those businesses that are what I call lumpy, so businesses that are reliant on a series of one-off events, contracts, life for those businesses is always a little bit up and down, but the ups and downs are magnified during COVID. So we've been talking to clients about how can they build recurring revenues, so how can they have more certainty about their revenues, and this is often something that is an important component of building value ahead of a sale. So using M&A to find businesses that assist in that, and also from those business owners thinking about a future exit. An acquisition can be a way of scaling up, making yourself bigger, making yourself more appealing. And if you can buy a business at 5 times multiple, but you can sell at 7 times multiple, you also get that, what we call arbitrage in terms of those two valuation points, can be beneficial in terms of the ultimate exit. Just a couple of or three examples of recent work that we've done with clients of the firm. So PAM Group is a specialist healthcare consultancy, recently sold. In the 3 or 4 years before the sale, they made a series of acquisitions of smaller businesses, much smaller businesses, sort of £1 million turnover businesses. But the accumulation of all of those acquisitions made a massive difference to their earnings. EDM is an aerospace business, reliant to a degree on large contracts, wanted to find or sort of balance up its business with some recurring revenues. So it started to buy businesses that provide training service to the aerospace industry. And again, in terms of that particular acquisition, very modest in terms of scale, £1 million turnover, £1.5 million turnover, but slotting into a much bigger business was very appealing. And finally, Panaceum, different model, 2 entrepreneurs wanting to do a buy and build in the food sector. They made one acquisition last year. We've looked at a series of potential acquisitions for them, and ultimately during the course of late last year, successful in buying this company, Bingham's. Again, not a huge business, but what they're looking to do is buy a series of up to £5 million turnover businesses, add them together, drive some synergies, and the long-term plan is to sell that group. And Dan, who's one of our panel members, was very helpful in providing some of the funding for that acquisition. So
okay,
we'll move on to Ben now.
Yeah, we'll move on to valuation and diligence through the acquisition process. So currently, businesses are typically being valued on their earnings ratio. So looking at their average profits and applying a multiple to arrive at an enterprise value of the business. That enterprise multiple is currently trading at around 10 times for SMEs. That multiple is skewed, however, because it includes large deals in high value sectors that we talked about earlier, TMT and healthcare. And as we say there, they are trading at premium multiples at the moment, and have been over the last 12 to 18 months, given how they've performed throughout COVID. Smaller SME businesses typically selling at between 4 to 7 times EBITDA. The actual value of EBITDA, the size of EBITDA, can impact the multiple. A business that's generating 500k versus 5 million is likely to be more volatile and less able to withstand kind of some difficulties. So you'd be paying a lower multiple for those lower earning businesses. And then different sectors. So an engineering business versus a tech business, you'd expect to see a tech enabled business to be at the higher end. What drives valuation is kind of the visibility on that earnings, how maintainable and sustainable is the earnings going to be in the future. So do you have recurring or committed revenues? If it's project based and lumpy, as Nigel mentioned earlier, then you'd be looking to apply a much lower multiple to the profitability of the business. When we look at businesses, we look at the management depth and their expertise and experience and knowledge to be able to grow businesses, to grow the value, take it to the next stage. And what actually is the growth prospects of the business? Is it just going to be a business that generates the same earnings year on year without any real growth, organic growth? I think what we're seeing at the moment is 100% in deals that we're doing, cash payable at completion 100% is quite rare, and this is becoming increasingly common because it's becoming more difficult to get the true underlying earnings of a business, because have they had a bumpy year because of COVID? Have they had to take on extra costs because of COVID? What actually is that maintainable EBITDA of the business? And because of that uncertainty around earnings, a lot of structures involve earnouts over 1, 2, 3 year periods. So a level of maintainable earnings is assessed and agreed during due diligence. However, the value isn't payable until a much longer period of time once that earnings has been achieved in future years.
Thanks, Ben. So I talked about future proofing in terms of diligence. Just quickly, everyone knows the challenges that businesses are facing, but one of the things that we often see is that bigger companies looking at owner-managed businesses often question the level of overheads. So owner-managers run their businesses very differently from bigger businesses. So if you are buying a business, just have a think about, is there enough overhead in that business for the way you want to run the business? Is that business very dependent on key individuals? As Ben said, has COVID skewed performance either up or down? Is it maintainable? So certain sectors have done really well during COVID, certain sectors have done really badly. So can you actually assess what the proper ongoing run rate is going to be? Everyone knows about inflation, rising costs. So if you're looking at a set of historic numbers, you just need to make sure that you can adjust those numbers and take into account inflation. And can the business pass on those costs? So a profit's going to remain defendable in the context of inflation. Also, again, everyone knows about issues with the supply chain. So yes, you might have orders, but can you get the product in to sell? Is your supply chain going to get in the way of generating profits and cash? The labour market in a lot of sectors is extremely tight, and costs are rising. So again, you need to factor that into your projections. One thing we're seeing, particularly if you want to go and raise external equity, is the growing importance of ESG, which is environmental, social, and governance concerns. So if you're importing product made overseas, are they operating to the appropriate levels of human rights, labour, etc. Green issues are also coming to the fore. So we're beginning to see sale processes where that level of the diligence is including those sorts of aspects. Just watch out for backlog creditors, deferred tax liabilities during COVID. Make sure that you identify those, and then also don't overlook implementation. So we see a lot of businesses spend so much time and effort doing the actual acquisition itself that they don't think about the future. So and the implementation. So next slide, Ben. You need a plan to make the acquisition work for you. If you leave it on its own, it won't work. So all those things on the slide there you need to think about. And just in terms, quickly, finally from me, in terms of outlook, we see 2022 being as strong as 21. Those sectors, tech, healthcare. If you own one of those businesses, if you don't want to sell it, then now's the time. But there are those value opportunities in sectors like manufacturing, hospitality, retail, transport. All of those sectors have been affected by COVID. So that's where the better value opportunities are going to be. And then finally, we do talk to a lot of business owners. As I said before, they're not necessarily proactively wanting to sell, but they're certainly aware, conscious of risk and wanting to de-risk. We will see more distressed opportunities because of the debt pressure, but also just the pressures of inflation, etc. But as I said at the outset, these market conditions, it will start to slow down. I suspect probably not for another 18 months. But if acquisitions are part of your long-term plan, doesn't stop you going out and beginning the process now, developing relationships. And as I said earlier on, if you are patient, you will find opportunities. So that's enough from Hurst, I'm sure. So over to Dan. Thank you very much for bringing us out, Dan.
Thanks, Nigel. Thanks, Ben. And thanks everyone for dialing in and giving your time again. Yeah, so I've just come on to talk about the funding landscape and how to go about using funding to help you on your acquisition with your acquisition strategy. So, as with all these processes, as Nigel and Ben were saying, the market's incredibly competitive at the moment, and there's a lot of sellers and there's a lot of buyers, and a lot of the deals we're seeing, there's a lot of competition on each individual acquisition. So the availability of capital is key, and if debt is part of that package, it's key that you get that lined up early on to enable a smooth process, and which can also be fundamental to you winning the acquisition, rather than a debt provider that may not be prepared and may slow down the process, which has the opposite effect. So it's worth highlighting at the moment that obviously since the financial crisis back in 2008, when it was just the traditional sort of high street banks that were the main lenders that dominated the funding landscape, there's now a number of funders across a number of different funding lines. So Shawbrook, for example, are classed as a specialist lender. We're a bank that lends off our own balance sheet. We've got 7.5 billion deposits, and we've got 8.5 billion assets, which is funding into the market. There's also others in our section of the market which are outside the high street banks. Typical sort of customers we're looking at are anywhere between 500,000 and 8 million EBITDA, and we're really looking to drive the growth within that SME sort of lower mid-market sector. So what I would say is, whilst your traditional high street banks will be supportive, there's other options outside of that, and that's through specialist lenders like ourselves. There's also debt funds who traditionally operated in the sort of 25 million plus borrowing market that are now coming into the SME lower mid-market with some innovative structures. And then you've got secondly M funders that can come behind your high street bank or can come behind us to maximise debt quantum, and therefore could drive your strategy quicker and increase headroom and make that integration that Nigel and Ben have been referring to easier in the short term. In terms of ourselves, not speaking for other lenders at the moment, we construct facilities across both asset-based lending and cash flow, or a mixture of the two. So we have two funding capabilities that we can take to market. So an asset-based lend we use where it's maybe an asset-heavy business, or if you're doing more of a turnaround, or you're making a distressed acquisition, a lot of the time you can leverage up the assets within that business, whether that be plant and machinery, stock, or property. And then we have the traditional cash flow, which is typically sort of 3.5 times combined EBITDA of both businesses. So you take your EBITDA of your own business, you combine that with the EBITDA of the business that's being made, and you can raise debt based on those cash flows. You might consider both options, or your business might only be suitable for one. So, for example, if it's a tech business, very little assets, it's more lending off the cash flows of the business. If it's a manufacturer with a lot of assets, cash flow might be an option, or additionally, an asset-based lend may be an option, which is typically a bit more covenant light and a bit more amort light, or repayment light, and can therefore maximise cash and help you with your strategy. What we're seeing more and more as well is the use of sort of committed accordions and acquisition facilities. So a lot of the deals we're seeing now, again as referenced by Nigel and Ben, are coming with deferred consideration or earn-out consideration, and it's important that you seek the right advice and understand how that can impact the cash flows going forward. So we're doing committed accordion facilities for both earn-out and deferred consideration, and that would be a commitment now for us to fund some earn-out consideration so it doesn't impact your cash flow, or a commitment now for us to fund some deferred consideration so it doesn't impact your cash flow. Equally, we can do the same with acquisitions. So number of the examples Nigel gave were buy and build strategies. So it might not be just one acquisition you're looking to do. You might be looking to make a few over the course of the next 12, 24 months, and we can effectively put a facility in place which gives you a pre-agreed amount to go out and make those acquisitions and effectively bolt them onto existing business. In terms of the typical terms leverage, I mentioned leverage before. Leverage on an asset-based lend is less of an issue. We'll more look at the advance rates against the individual asset classes. So leverage doesn't really come into play, which is why it's good in a sort of turnaround or distressed acquisition scenario. A cash flow, as I said, up to sort of 3.5 times combined EBITDA of both businesses. Now, that's not a sort of one size fits all. Each business will be assessed independently, and a leverage on a tech deal that's driving SaaS revenue would be higher than leverage on a more lumpy business, as Nigel explained before. But I suppose the overarching theme with the funding slide is just look, there's plenty of options out there in the market now for you to be able to get a facility that's fit for purpose, which includes a mixture of both repayment and bullet, which is interest only facilities, which can help you both maximize debt quantum, reduce debt service costs, and maximize headroom whilst making that acquisition. So you can focus on making the acquisition rather than repaying the debt over a short term, which is an important feature. But we'll just move on to process. In terms of process, so this is key for me, especially when you're making acquisitions, in terms of seeking the right advice. So one example Nigel gave before was Pannone, and we managed to complete that from sort of credit approval to full completion in as little as just under 2 weeks. The reason we did that is because the business had gone to Hearst, and they thought about all the things and all the risks that happen when making an acquisition, and articulated those in a succinct way to myself to be able to enable us to make a quick decision. We also had the correct financial models and so on and so forth to enable us to do our analysis and diligence to move it forward quickly. I've worked on a lot of deals in the past where perhaps the customer has not been as prepared as maybe they should be, and it delays the process through the diligence phase, and can ultimately impact the acquisition, which is what I was referring to before. And key issues from a lender perspective are integration, management, what the synergy assumptions are, what the bandwidth is a big one. So if you've got a business in Crewe, and they're making an acquisition down south, what's management's experience and how they're going to manage that acquisition, and all those are important factors that should be considered up front. So I'd very much recommend you seek advisor help when raising debt packages for acquisitions. That they're not simple. A lot needs thinking about, and the more preparation you do up front, ultimately the easier you make the process as you go through it. And that just feeds into my next point, really, about reported standards of quality of information. Just making sure your own house is in order and you've got the management team and the financial capability to take on the acquisition before you go on that acquisition trail, and making sure you've got the overhead and the resource to be able to implement and take those acquisitions forward. In terms of our individual process, we run in line with, we'd typically see something from the likes of Hearst through an IM. We then take it to first stage credit, which takes us circa a week. Following first stage credit approval, we traditionally or usually go into financial due diligence. That's more so on cash flow facilities. If it's a fully asset-backed facility, we won't need diligence. So again, that's where sometimes people might progress down an asset-based lending facility rather than a cash flow facility. There's advantages to both, but if it's a cash flow facility, we then progress with FDD. We then progress into final credit. So that whole process probably takes between 3 and 6 weeks. And then we go into legal documentation and aim for a swift completion. But the more prepared you can be at the outset, the better from our point of view, and consideration to deferred elements, earn out, and all those sorts of things need to be considered. In terms of a few examples that we've done recently or are in the process of doing, we did a buy and build in the food manufacturing space. It's quite a challenging sector at the moment. Obviously, inflationary pressures have hit that sector. Preparation was key. Actually worked with the guys at Hearst on that one, which was the one we completed really quickly from sort of HO heads of terms to completion. Ultimately providing a facility across repayment term debt and bullet term debt, which gives the business plenty of cash headroom to execute the strategy. They're not just looking to make this one acquisition, they're looking to make a number of them. So therefore, cash headroom within that facility was key to enable them to implement those acquisitions. So the key challenges on that deal were sector really, and making sure that, given they were smaller businesses, that the management in the individual businesses were suitably tied in and incentivised, all of which helped us do and present to credit, and we got an approval quickly. That was a cash flow facility. The next one we're doing at the moment is a buy and build in the precision engineering sector, so it's more of a manufacturing business. They've got a similar business operating in the same space, but they're doing this buy and build outside that business. That's more on an asset-based lens, so they're investing in businesses between $500,000 and $1 million EBITDA, and we're typically leveraging the stock, receivables and property to provide them with the capital they need to make those acquisitions, and we're doing that on an ongoing basis. And that's working well for them. They've made 2 acquisitions so far. Key challenges on that are less with the customer, but more with it's taken them a long time to do each acquisition, because sometimes the vendor is less prepared than they should be, which is delaying the acquisition timeline. So, for example, the one we're funding at the moment has been going on about 12 months. They've been speaking to them at sort of heads of term stage. So, sort of emphasises the point about being prepared both sell side and buy side, which is useful. The other one, we've got an acquisition on at the moment for an existing customer of a complementary packaging business, albeit operating in a different end sector. That adds significant EBITDA to what is already an extremely profitable business, but they also will get some valuation arbitrage by combining the 2 businesses together. So it's taken the businesses from circa 3 million EBITDA to 6 million EBITDA. Again, an extremely competitive process, and something there's earn out structured in there, and there's quite a few complexities. So it was key that we got all that information up front to be able to make the decision. And then finally, we are working on a marketing group refinance, which has been the culmination of a number of acquisitions done since 2018, of, again, businesses making between $500,000 and $1 million EBITDA in the marketing space. Done 7 acquisitions to date, and we're providing a refi and accordion facility to help them drive that to sort of 15 in the next 12 to 24 months. One bit I've not mentioned really, I think the key challenge at the moment for lenders, and Nigel highlighted it then, is the diligence on some businesses have been impacted by COVID positively, some businesses have been impacted by COVID negatively, some businesses haven't been impacted. all businesses, you would think to a certain extent, have. It's actually understanding what the sustainable position of your EBITDA is, and that's key to a lender, particularly on a cash flow deal, because we need to make sure we're leveraging off the right number. And it's key for you because you want to make sure you're not putting too much debt in the business and over leveraging the balance sheet. So I think a lot of work can be done if you are seeking advice on the sustainability of that EBITDA and analysis of the revenues and profitability coming thereafter. But thanks for your time. So if anyone got any questions at the end, please don't hesitate to ask. Pass over to Tom.
Yeah, thanks, Dan. Over to Tom.
Okay, well, thanks everyone again for joining. So I'm Tom. I'm a partner in the corporate team at Pannone, specialising in M&A and private equity. And what I'm going to do today is just take you through, I guess, the legal aspects of an acquisition, and give you some recommendations for trying to make things run smoothly. I wanted just to kick off, just to give you some observations on the market. You know, there's echoes certainly with what Ben, Nigel, and Dan were saying. It's been a really, really busy 12 to 18 months. The sectors that we're particularly busy on buy side would be tech. So we've got an acquisition at the moment, which is looking at procurement software. We did a really interesting deal involving a business that specialises in the metaverse, which I'm sure you've heard about as a concept. We didn't know what it was in June, and now it's we're doing M&A in the metaverse, which was really interesting. Financial services is another sector that seems to be kind of pandemic proof. I think we did 4 financial services deals in December alone. And then food and drink seems to be quite an interesting market as well. We've got an acquisition on at the moment for a halal meat distributor, and that's acting on behalf of a French buyer. And we did an acquisition for a Dutch seafood company who invested and acquired a stake in a Scottish salmon farm as well. And that was in the Isle of Skye. So a real kind of variety of stuff that we're looking at the moment. I guess one common theme through a lot of it is that overseas buyers are involved on pretty much most processes that we're on. I'd say the majority of the work that we do is cross-border. And it kind of goes back to what Nigel said before about the fact that it is competitive. You know, there's a lot of buyers looking at that UK assets, and that's not just UK buyers. Obviously, you've got the overseas purchasers as well. So it seems like that continues to be the case. Yeah, it's something to keep an eye out for. Obviously, if you're making an acquisition, it's just being mindful that, you know, there will be other people there as well. So what I wanted to explain today is what a lawyer actually does on a transaction, and I'll come on to that in a bit more detail on the next few slides. I guess any good lawyer's objective, I would say, on a deal is to do 3 things, and that's to reduce the risk, reduce the cost, and reduce the delay. So when we say reduce risk, it's not just reducing risk in terms of due diligence. It's, you know, also things like, you know, reputational risk if the deal doesn't go ahead, risk that you spend too much management time getting bogged down in matters, and then also just, you know, identifying things that come out of the due diligence and making sure they're fixed as part of the exercise. Similar to that is reducing costs. So, you know, again, the lawyer's role is to go in and kind of identify where there may be things that need to be fixed before completion, and try and push some of that cost back onto the seller before we go to closing. Reduce some of that cost that is incurred by the buyer, both from a financial perspective and also from a time perspective, and also reducing delay. It's really, really important that we spot things quickly and we deal with things quickly. And certainly when the corporate lawyers get involved on a transaction, it's usually, you know, at the end of the beginning, and it's our role to really drive things through to conclusion. So, you know, you've got to bring the pace to the transaction basically, and that's what the lawyer's role should be on that final furlong, as it were. The questions we always get asked at the start of every acquisition: how long will it take? How much is it going to cost? And what are the risks? And there's a really, really easy answer to that, and the answer is it depends. The length of time it would take, I would say, I mean, obviously it depends what you're buying and where you're buying it. But when you sign heads of terms, it typically takes about 6 to 8 weeks as a rule of thumb, I would say, to close off the legal process, We've done it much quicker than that. We've done it, 5-10 days. It's taken much longer than that. It's, literally years to get things done. But as a general rule of thumb, I'd say kind of 6 to 8 weeks if that's what you need to build into your timetable. In terms of costs, it will kind of vary greatly in terms of what you're buying, who you're buying it from, how much you're paying, how you structure the price. What I would say is that when you're speaking with your lawyers at the start of the process, they should be able to give you a very clear and prescriptive overview of what their costs will be. In 2022, lawyers work on a fixed or a cap fee basis. It's not the case that they just turn the clock on at the end, the start of the deal, and turn it off at the end. It doesn't work like that anymore. So, lawyers have to be much clearer on what their role is and what their fee would be. So make sure you're having that conversation with them at the start of any process. And in terms of what the risks are, again, we'll look at some of the kind of common DD risks that can come up on a transaction. I mentioned before, there's other risks that could be relevant to the business in terms of the amount of management time it might suck up. I mentioned, also reputational risk if it falls over and it's someone that you work with in the market, and there's damage done that way. And again, the lawyer's role is just to make sure that doesn't happen and try and build a wall around the buyer and protect him. Okay, so the key features of the legal process. So this is where I guess we kind of come onto the scene really. So once Ben and his team have agreed the headline price for a deal, we start coming into the fold, as it were, to help structure the deal. And that's looking at what are you actually buying, and where are you buying it, and when are you buying it. It's quite an important question, what are you buying? So you can either buy the shares in the business, you could buy some shares, you could buy the assets, you could buy some assets, and it's quite key to get that right. And I would say, with your buyer's hat on, it's generally better for you from a legal perspective to acquire the business and assets of a company rather than the shares. And the reason for that is because if you buy the shares, you acquire the company kind of warts and all. So if you buy the assets in the business, you can kind of leave all that historical risk behind. The challenge is that sellers will almost always want to sell shares in the company because they get a better tax treatment on their proceeds. So again, you need to think of that up front at the start of any process. Once that structure has been agreed, then the lawyers again will step in and help draft the heads of terms. Can't emphasize how important heads of terms are. They are non-legally binding generally, but they do have some weight. And there's a surprising number of transactions where we can kind of refer back to the heads and say, look, guys, this is what we agreed. Why are you rowing back on some of these principles? They do have some power. What they do is they set out I used to say the roadmap for the deal, but because Boris kind of overused that term, it's more like the plan for how you're going to get from A to B. So it sets out who's doing what, when you're going to do it, what the responsibilities are, what you're paying, how that payment is going to be made, and most importantly, from the buyer's perspective, it will contain exclusivity. And this is a legally binding obligation on the sellers that they can't go and talk to someone during the exclusive period. So that is super important for a buyer because you want the reassurance that for the next 6 to 8 weeks, no one is going to, from the sell side, is going to start talking to other competitors in the market about the target. So it's really, really important to get clear heads of terms boxed off. I would definitely recommend you get the lawyers involved for that stage because unfortunately, we've been involved in too many processes where kind of heads are signed before we see it, and then we look at it and think, why have you agreed this? So yeah, I would definitely recommend they're sent to advisors as soon as possible. Okay, once heads are signed, then you get into due diligence. So again, I think Nigel, Ben, and Dan have all mentioned this. It's effectively an audit of the company, and nowadays you'll have various different providers doing various different kind of DD exercises from legal, from financial and tax, insurance, tech, data protection, lots of different providers depending on what you're buying. The key part of all of it, I would say, is that it's making sure that the DD exercise is scoped correctly. And what I mean by that is it's very, very easy to spend a lot of money on due diligence and lifting up every single stone and seeing what's there. Again, when I first started doing this about 15, 16 years ago, the DD reports were like an inch thick, and they didn't really kind of contain much of interest. You know, nowadays it's much punchier. Clients are very time poor. They want to know what the headline issues are. They want to understand specifically what their risks are, and they want to know how you propose that you're going to fix them. So this is why I've said on the slide, you have to make sure that the DD is effective, and you agree the scope at the outset with your advisors as to, you know, here are the things I want you to look at. And therefore the report that they produce is much more compelling because, you know, it only focuses on those areas of the business that you're interested in. So that's, you know, it's very much something that can be agreed up front. You know, don't let the lawyers just kind of go off by themselves and look at what they think you want to look at. Obviously, DD will be affected by the lender's requirements as well. So Dan and his team may have some specific questions that they want to include as part of that process. I guess the key things coming out of DD exercises at the moment, arrangements with furlough come up kind of time and time again. Obviously, most businesses were making use of the furlough scheme. Most businesses didn't quite do it right, and buyers are wary that if it's been done incorrectly, then the revenue could come back and claim for sums for improper furlough. Now, the kind of guidance we're giving to clients is, look, you know, there's a difference between administrative formalities not being carried out correctly and, you know, people committing mass fraud and saying people are on furlough when they actually weren't. So there's a real spectrum there, but it's something that when we're on the buy side, you know, buyers are quite interested in exploring. So that's usually quite high up the list. The other thing that people are tending to spot on DD nowadays is data protection. It is a kind of huge issue everywhere now. Again, when I first started doing transactions, I think the data protection questions were about 2 sentences long, and now there's like 3 or 4 pages. Most businesses don't comply with data protection law. No matter how hard you've tried to get GDPR right, there will be some deficiencies there. And, you know, if you're on the buy side, it's just exploring to what extent those deficiencies actually matter. Some of the other key things coming out of DD that we've noticed, anti-bribery and corruption, obviously is a big thing, particularly if there's an overseas buyer. General compliance with laws, obviously, is a key one. And there's some new legislation come out as well, called the National Security Interest Act, which came out in 2021, where certain businesses that are of a national concern may require certain notifications to be given to the government. And, you know, that's either done post-deal, and, you know, if it's of a certain importance, so it, you know, relates to the military and telecoms, etc., then, you know, the government can step in and start asking questions. So it's something that's really front and center on any DD exercise at the moment. And I think it only came into force in November, December. Okay, so we've signed our heads, we've done our DD. We then get into the sale and purchase agreement. So I've called it share purchase here, but it could be an asset purchase agreement as well. You can have different types of SPA or sale and purchase agreement. So some might be conditional. So you sign the agreement and it completes when certain conditions have been satisfied. So I think in the last year, we've done transactions that have involved the Environment Agency, where we had to get a permit moved. We've had the Competition and Markets Authority involved, where the market share of the buyer was sufficient that it kind of triggered competition law issues. So we had to get them involved, which kind of added 4 months to the process. And then the big one we've seen is financial services. So seeking approval from the Financial Conduct Authority was a big one. And, you know, I think in 2020, it was taking about 10, 15 days to get a response. And now it's taking 3-4 months. So if you're in a regulated sector or you're acquiring a business in a regulated sector, you know, it's key that your contract is conditional and you have to build that timetable into the overall plan. So key part of the share purchase agreement is around price. So, you know, what you're paying, when you're paying for it, are you holding any money back in a retention? Are you putting any money aside in an escrow to deal with any issues? And all of that is driven by DD. So both FDD and legal DD will kind of inform your view as to whether we should be holding some sums back to deal with a particular risk. As both, you know, the guys from Hurst and Dan have said, earnouts are much more prevalent. They seem to, you know, people in the financial world seem to quite like earnouts. Lawyers generally hate them because they're really, really difficult to draft. Ben and I have had some fun on some earnouts on previous transactions because they're just really uncertain, and you have to kind of forecast what's going to happen in the future. So unfortunately, my heart sinks when I see an earnout, but they are much more prevalent now, particularly with COVID. The other part of a purchase price could be in consideration shares as well. So this is where the price is paid actually in shares in your company. And again, all of that combination of stuff is determined by the business itself. So there's no hard and fast rule as to what you should pay on completion. It's all driven by the DD and the market. The next key feature, warranties, indemnities, and disclosure. Anyone who's been involved on an acquisition will know about this. It's probably 60 or 70% of the SPA relates to warranties and indemnities, and 90% of the discussions probably relates to warranties and indemnities. And these are, from the buyer's perspective, quite a key way of protecting against any issues. So it's putting in place legally binding statements that information that's been provided is correct, and if any issues come up in the future, then the seller will be responsible for it. A product I wanted to talk about here, just to note it, is warranty and indemnity insurance. And this is something that kind of 10 or 15 years ago was really slow and expensive, and nowadays is actually quite a good way of putting in place an insurance policy for the buyer that gives you some recourse if there's a claim under the SPA. So if you've got a really disparate shareholder base, or they're scattered around the world, or there's institutions in there who just refuse to give warranties, then a W&I policy is quite a good way of unlocking that issue. And it's it's a relatively modest cost, and gives the buyer some comfort that there's a pot of cash there that can be used to protect if there is a problem. The other thing that's not on this list, which should be, is restrictive covenants. So again, from a buyer's perspective, one of the key things you want to make sure is that the sellers don't trouser the cash and go and set up shop down the road. So that'll be a key thing to include in the SPA. Next part of the legal process, which is important, is obviously the people. And generally speaking, from the buyer's perspective, obviously the management team of the buyer is really important, and you want to make sure they're on the right terms. They've got proper contracts of employment. They've got decent restrictive covenants. They've got proper notice periods. Again, they can't just walk off the job and go and work for a competitor. Things like management incentives and share option schemes. Are there any in place? Are we going to exercise them pre-completion? If the answer is yes, are we doing anything post-completion? How are you going to keep these guys motivated once you've done the deal? The kind of the final aspect is completion, and that's kind of bringing everything together. And this is a key role for a lawyer on the deal. It's issuing all the documents for signature. Thankfully, most of that can be done electronically now. Checking all the completion deliverables are in, checking all the conditions precedent to the lending is in, and making sure the money is moved in the right way. I would say completion meetings nowadays are not as exciting as they used to be. So it used to be a big room full of paper and generally happy clients and champagne and things like that. And it's now kind of completing things in your spare bedroom, which isn't it's not quite as romantic as it used to be, but it's certainly more efficient. And again, the buy side lawyer's role will be key on that, of bringing all that together to a smooth conclusion. The last bit, I suppose, is post-completion. And again, the buyer's lawyers will typically be responsible for carrying out certain formalities. So filings with Companies House, with HMRC, and things like that. And, producing a Bible of documents that give you a record of what we've done. So they're all the key features of the legal process. The recommendations that we would make are here. I have to say quite a few of these are very similar to what Dan, Nigel, and Ben have already said. So I guess it kind of underlines that some of these things are really fundamental to a deal. Planning ahead. I mean, this is pretty much exactly what Dan said. Trying to anticipate every step at the outset of a process. I would say the documents list is one of the most important things you can have in place at the start of a deal. And that is, as the name suggests, it's a list of all the various different transaction documents you're going to need. And it's thinking through, who do you need to sign something? Are there third parties involved? Is there an outgoing funder you need to speak with? Is there a disgruntled minority shareholder you need to get on board? Where are they? Is anyone on holiday? Do we need powers of attorney? And really anticipating every single step so that when you get to completion, you've got everything set and ready to go. Keeping your eye on the ball is really, really fundamental, and this applies both to the buyer's organization and also the target. So we've seen it so often where the sellers are so absorbed in the process that they kind of take their eye off the ball, and the numbers start going a bit soft, and that's obviously bad for them and also bad for the buyer. But even from the buy side team, if you've got key members of your management engaged on the process, it's really important that you try and keep that as efficient as possible. You still need people to go and run your own business while this is going on, because it's quite an all-encompassing exercise. And if you engage advisors to help, then let them soak up some of the pressure. Push some of the pressure back onto them and let them take some of the strain. Don't try and do it all yourself, because it is a lot of work to do, and you've got your existing business to run at the same time. Keep up the momentum. Deals are kind of won and lost based on momentum. Once you've got some good pace on a transaction, it's really easy to kind of maintain. I would recommend you have weekly calls with the kind of buy side advisors, maybe even with the sell side team as well. And on those calls, set and agree key milestones. So who's going to do what and when. And you'll be surprised that the 2 hours before your Friday morning call, just how much work gets done, because everyone's trying to get everything out of their court so they don't look like prats on the weekly roundup. So it's a good way of keeping everyone's feet to the fire, really, and making sure that transactions don't drift. So really trying to keep that pace going, because that's the best way to get things over the line. The penultimate point, concentrating on the big picture. It's really, really easy to get bogged down in the minutiae on a deal. And this goes back to what I said before about due diligence and trying to make sure you're focusing on material issues. We sold a hotel business in the Lake District last year, and the buyers were asking us to provide them with a written copy of a knife sharpening contract that was worth £17 a month. And we worked out that the lawyers asking us that question incurred more time on behalf of their client than was actually the contract was worth. So it's not getting bogged down in that level of stuff. Not every company is perfect, no company is perfect. So it's understanding and setting a level of materiality that you just focus on and concentrate on those issues. Look at the bigger picture. And then the final point I would say, again, I think it's been mentioned, is just engaging specialist transactional advisors. So you need to have proper corporate finance advisors helping you on an acquisition, and proper experienced lenders who will assist with it. The people who do your accounts on a day-to-day basis might not be the right people to help you out, in structuring an acquisition and going out, seeing what the market is, negotiating price, getting on the front foot, structuring a price, getting the right multiple. And all of that will be of such high value to you in terms of getting the right price for your deal. And it also makes our life much easier because all that commercial negotiation has been done, and you've got people who understand the way that these mechanisms work. So yeah, please make my life easier by instructing specialist advisors, and it'll definitely help. Okay, that's it for me.
Brilliant, great. Thanks, Dan. Thanks, Tom. Thanks, Nigel. Thanks, everyone, for joining today. We just checking the Q&A. We have 2 questions that have come through. If there are any more whilst we are answering these questions, then feel free to pop them in the chat box. Question for Tom. Typically, what kind of restrictions or controls are placed upon the sellers during the earn-out period in terms of what they can and can't do? And how is this handled in the SPA?
It depends. If the sellers are staying with the business, which presumably they are, then there will usually be a schedule within the sale and purchase agreement that will set out what can and can't be done on during the earn-out period. And I think there's 2 kind of competing tensions, really. There's one the buyer's position in the, you know, this is our company and we'll run it the way we want to run it, you know, versus the seller's interest of making sure that the business is run on a consistent basis, and you know, everything is done as possible to help maximize the earnout. So it really is a question of negotiation, really, and it's trying to strike the fair balance between making sure the seller's interests are protected and making sure, you know, the buyer doesn't have a situation where they're being told what to do by the seller. So what you would usually have in the SPA is a schedule of consent matters. So it will say something like, you know, the sellers aren't able to do this without buyer's consent, and the buyer isn't able to do this without seller's consent. And there'll be things in there as well, so that, you know, if the company is sold, what then happens to the earnout? If the company's you know, acquired, or, you know, makes an acquisition, what then happens? So it's all fairly detailed stuff, and would be addressed in the SPA.
Thanks, Tom. And we had a question quite early on in the seminar. Would you have a cold list for selling a business also? I think that's in relation to potential acquirers of a business that we might be selling. So yes, we would typically speak with the shareholders of the business and agree a list of businesses following the research that we will do in your specific market. Typically, we'd come up with around, in the initial draft, 50 potential acquirers. It's all dependent on the market. There might not be 50 there, it could be 20. We then whittle them down to approach the buyers that we think are most appropriate for the business that we're selling. We want to keep it as confidential as possible. So in the initial stage, we want to gauge appetite from a small list of appropriate buyers. So hopefully that answers your question there. What we will do anyway is after this seminar, we'll circulate contact details for the panelists. So if anyone has any direct questions afterwards, I'm sure Tom, Dan will be happy to take any direct questions up with you. One more question just come through. To what extent should vendor contract with the management team in terms of future incentives? To what extent should vendor contract with the management team in terms of future incentives? Is it better to have them tied in first, or leave it to the acquirer to finalise, negotiate those terms? Nigel, one for you.
Sorry, I was on mute. I mean, what I would say is I think if you as the buyer believe that the management team are mission critical, then you need to get yourself directly in contact and have those conversations with those team members. As the vendor is unlikely to want you to do that until relatively late in the process. So there's always that tension between confidentiality and having those types of conversations. But as I said, if it's an owner managed business and the owner is taking a chunk of money and you need to incentivize other members of the management team to stay, you need to directly control that process.
Thanks, Nigel. Okay, 9:40. We'll leave it there for today's session. Thank you once again for everyone that's attended, and for the panelists for talking to us today. Thank you.
Thanks all.
Thank you.